At Staples Business Advantage, nothing can top the smarts and instincts of the thousands of experts on our team. While AI excels at
processing data, automating tasks, and providing insights for better decision-making.
And when they're used together, they're far more powerful than either is alone. Whoa.
I've never felt more alive.
Let Staples Business Advantage use today's latest innovations, plus our team's experience to make business easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
G'day and welcome back to Shares for Beginners. Today I'm speaking with Robin Bowerman from Vanguard Investments Australia. He's the Head of Corporate Affairs at Vanguard and a member of the executive team. Robin's also the Vice Chair of the Self-Managed Super Fund Association. Vanguard is a pioneer of index investing, something we'll explain during this interview. They are providers of ETFs, which are exchange-traded funds. We'll go through what they are and about Vanguard's unique corporate structure, which is designed to maximise returns for investors. Before joining Vanguard, Robin was a leading financial services writer, commentator and editor. But first of all, can we start? What team do you follow, seeing we're talking to you from Melbourne?
I'm a long-suffering Melbourne supporter for my sins. So at Vanguard, we talk about long-term investing. With Melbourne, you definitely have to be a long-time supporter.
You went into financial journalism, but not on the financial side of things.
No, I was. My background was in general sort of political and news journalism. When I was working on the Sydney Morning Herald, I got asked to. I think someone had seen on my CV that I'd studied economics, so ipso facto, you must be okay at business. So they asked me to go around and relieve someone on holiday leave on the business desk for 3 weeks. And about 3 years later, I reminded them that it was only meant to be for 3 weeks.
Just going back a little bit to when you were at university and studying economics and so forth, did you do any share trading at that stage?
I dabbled a little bit.
Yeah, what was your dabbling like?
Extremely unsuccessful. With that, it's sort of somewhat ironic that I ended up with Vanguard index investing because I worked out from a fairly early age that direct share investing was either I was no good at it or it was closer to gambling than I liked. So I basically became a fairly conservative investor reasonably early on, and then obviously with the indexing approach that Vanguard pioneered, I then realised actually it's a lot easier to buy the whole market, or as Jack Bogle talks about, buy the haystack. Don't go looking for the needle. In
2002, you co-authored a book with Jeremy Duffield, who was the founder of Vanguard Australia. Can you tell us about that book?
Yeah, Jeremy and I did a joint presentation at an Australian Investors Association conference up on the Gold Coast, actually, and the topic of it was really around what are the mistakes that we all make as investors, and how can you learn? A hell of a lot cheaper to learn from other people's mistakes rather than making them or repeating them yourself. So Jeremy and I did a bit of a discussion, and I've got to say, going into this presentation, if nobody had been prepared to share their mistakes as investors, it would have been a very short and somewhat dull presentation because we really didn't have a lot of material to work on. We were relying on the audience to be prepared to put the hand up and say, I did this and, it was dumb, or I learnt this and whatever. But as it worked out, people were almost fighting for the microphone to share. This was a pretty savvy investor crowd, so people were very comfortable talking about things that they'd got wrong over the years, including some pretty exotic agricultural schemes and some Vanuatu investment schemes, I remember. So we came out of this presentation with sort of our head spinning a bit because it was just this fantastic sort of trove of sort of shared knowledge. So we decided to come back at the conference the next year, but this time we were a bit smarter and we taped it and transcribed some of the lessons, and then basically said about how do you group the different types of mistakes, whether it's trying to time markets, whether it's following past performance, whether it's, taking a tip from the bloke in the pub that you've just met, all these types of things we tried to group into categories of the most common mistakes that investors made, and the Wealth of Experience book was the outcome of that.
So what are some of the common mistakes that you found people were making?
Probably the most common one was the past performance issue, where something's gone up 10, 15, 20, 50, 200%, whatever, pick a number, and as human beings, we just assume that that's going to keep going. So people jump onto the bandwagon often as it's about to sort of turn down. So I think that was probably the biggest or the most common sort of mistake that people make. I mean, as investors, I think one of the really hard things for people to understand is that we're actually not wired emotionally to be great investors, because we're emotional beings. As people, we respond to emotions. We particularly respond to things like fear and sadly greed. So people typically will see people making significant amount of money in a certain type of investment, whether it be stock A or stock B or property A or property B, whatever, and think, well, I want a bit of that, and sort of that, and they jump on. But often, the reason at that point is that you're paying way too much for it. The market's sort of peaked. And if we look at the cash flows into, whether it's the Australian stock market or the US stock market, as markets go up, people put more money into the share market. When markets crack, as they did through the GFC, for example, what happens? People take their money out of the market. It basically means that people are buying in when things are expensive and they're selling out when things are cheap. And it's, Warren Buffett, I think, has the expression, would you rather buy things at a discount or buy things at a premium? We typically will go in when we're buying a television or a new phone or whatever consumer goods. We always go looking for the discounts. We look for the 20% off this, 50% off that. Yet in investing, when things are 20%, 30% on discount, because of the emotions around the market, that's usually when people are leaving the market as opposed to going into it. Now, having said that, it's a hell of a lot harder to put your money into something that's just lost 30% in value than it is to buy a TV that's on a 30% sale price. So understanding emotions and understanding particularly your emotional breakdown is actually very important to being a successful investor. My background, as you mentioned, comes out of the media. Obviously, the daily news cycle drives a lot of emotion.
There's a lot of information overload as well, isn't there, Robin?
Absolutely. Well, a lot of it is, frankly, noise. Being able to tune out is a really good skill as an investor. And I think if you look at the very successful long-term investors, whether professional or individual, they're typically people who understand there's something's of value and they take a long-term view of it, and they're prepared to wait out perhaps the first 1-2 years where things are not sort of bubbling along, confident that over time, the value will be there. So it's a tricky thing, understanding your sort of, short-term emotions. I mean, I think it was Benjamin Graham, Warren Buffett's sort of inspiration, who said that, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And I think that's a really critical thing for investors to understand. Are they responding to the sort of voting machine piece, the short-term noise, or are they actually looking for the long-term sort of weight that's actually going to emerge over time as, markets are reasonably efficient. They get it right more than not. But in the short term, emotions can drive values way out of kilter with what's actually the economic value.
I've heard you mention the idea of the importance of doing nothing. Is that where this comes in, doing nothing when you just need to wait for the market to get back to be more favourable to the investments that you have?
Yes, and I remember, through the GFC, when markets were, to be honest, were in turmoil, and it was a 1 in 70-year event. So it was pretty unusual and pretty extreme, and the way the markets had shed value and different companies had collapsed, etc. And the whole financial system was under stress. But I can remember Jeremy Duffield saying to me, this is a really interesting time to be investing. It's great. For people who are not retiring for 30 or 40 years, this is a terrific opportunity just to learn about markets, and they should do nothing. They should invest, stay in their super fund, keep investing the money in a regular sort of way, buying in, don't try and time it. And he was right. I mean, markets recovered. People that stuck to having a balanced sort of investment approach did pretty well. The people that actually in the GFC that got hurt, and I remember a good long-term friend of mine rang me up about October, November 2008, saying, "Look, Robin, I know you talk about long-term and staying in the market, etc., and all that sort of stuff, but I've had enough. I've just retired. I'm just seeing my account balance go down. I can't take it anymore. I'm going to cash." And I actually wrote a note in my diary and just noted the day, and then within 3 to 4 years, he would have been able to slip a lot easier, knowing his money was in cash or in defensive assets. But 3 years later, the return on the portfolio was 4 or 5% up because interest rates were still reasonably high. And then if you look at over a longer period of time, markets were up sort of 40, 50%. All that sort of income was. So it was a really good lesson in. You cannot argue that there's powerful emotions at work when markets are in such sort of volatile mindsets. But at the same time, the real trick is to look beyond it. Why are you investing? If it's for a house deposit for the next year, then maybe you are better off out. But if it's for your retirement in 20 years, 30 years, even 40 years' time, then, in the sort of Warren Buffett's language, you're buying into a discount. The market's a discount. So why wouldn't you invest into that sort of market?
So I just want to get on to ETFs. I've become very interested in ETFs over the last year because I've, like everyone, I've made mistakes. And a lot of people listening to this podcast, they've made mistakes with buying a stock and then it just tanks 20 or 30%. And related to that, one of the other guests that we had on this podcast mentioned the idea of single stock shock. And that's really stuck with me, single stock shock. And he's very much a champion of ETFs. Can you explain what an ETF is, please?
Sure. I mean, an ETF is an exchange traded fund. So it's really a pooled managed fund, which, typically in the Australian market were unlisted. An ETF is simply a listed version of it.
Robin, sorry, can we just go back a little bit? Because I just want to go back really to the basics of it. So when you speak about a managed fund, that's kind of like something that you would buy off the shelf and someone is actively managing, whereas an ETF is different. How is it different?
No, it's not that different because you're right in the sense that you can buy a managed fund which is actively managed, and you could pick a certain manager. Or you could buy an index managed fund, which is say tracking the Australian share market. So, for example, at the Vanguard, we have the unlisted ASX 300 fund, which gives you exposure to the whole Australian share market. The exchange traded fund, the ETF, is simply a listed version of the same portfolio.
So, when you say listed, it means you can buy and sell units in that that fund on the share market.
Yeah. And
it's easy as just opening up an account, your CommSec account or E-Trade account or whatever, and just going and saying, okay, I want this ETF because I like to be exposed to the ASX 200, for example.
Exactly. And so for a lot of people, particularly people like with self-managed super funds, they already have a discount brokerage account, whether it's, CommSec, E-Trade, Bell, one of the online discount brokers. They've already got a stock brokerage account set up. If you've already got that set up, then to buy the ETF is just like buying another single stock. With the difference being though that when you buy that one ETF unit, you are buying the whole portfolio of stocks, whether it's the US stock market, the European stock market, the Asian stock market, the whole world stock market. You can buy the MSCI World Index, which gives you thousands of stocks just with one share trade. That's the power of both the index fund and particularly with ETFs.
And I believe they're a lot lower cost than a lot of managed funds as well. Is that correct?
Yeah, that's true. Index funds typically are lower cost than the actively managed stuff, but then ETFs are cheaper again. But what you have to be aware of, though, is that with the managed fund, you're not paying brokerage. So when you're buying the unlisted managed fund, you're not paying a brokerage fee. So the brokerage fee, you have to pay the trading cost when you buy the ETF or when you buy and sell it. So just people to understand that ETFs are certainly lower cost, but you've got some other costs to actually trade them. Okay,
and about that, what I mentioned before with single stock shock, ETFs tend not to move up and down at the same kind of with the same kind of violence that a single stock can.
That's true because the bulk of assets in ETFs are indexed, so they typically are diversified across either whole markets or across market segments. For example, I think the average number of shares that the Australian investors hold is about 4.5. So if you think about it, you may own 4 shares. If one of those shares has a really bad performance, or even worse, goes bankrupt, then 25% of your portfolio is just disappeared. And that's pretty catastrophic in the sense of, you're losing a big chunk of your portfolio just because you've got, 3 or 4 stocks. What an index fund or an ETF typically would do is, so let's say you're tracking the whole Australian share market, it'll own north of 200 stocks. So clearly, if one major share collapses for whatever reason, it still has an impact, but you've diversified it across the 200 shares in the portfolio. So the impact on the whole portfolio is significantly less. That's just, just a simple way to diversify your risk. I often say that, diversification is sort of the one free kick we get as investors, because you can lower your risk profile by spreading your investments across the widest possible range of stocks, and that actually insulates you from one particular calamity that might afflict you. I mean, there's probably 3 ways to think about risk. There's as you talk about, the single stock shock. There's, if you pick an active manager, for example, the markets may go up, but if your manager's got the wrong stocks, then the manager risk comes into play, where they've made some bad calls, or they're out of cycle or something, and the manager doesn't actually perform in line. And the third risk is market risk. And you can, with an index fund or an ETF, you take out the first 2 risks. You take out the single shock. You take out the manager selection risk. And that leaves you with market risk. And frankly, market risk is more than enough for most of us investors. Because if you're watching, the ABC, the TV of a night, or you screen through the day, markets move up and down. And that's the market risk that you get with an index fund, where you're tracking a whole market.
At Staples Business Advantage, nothing can top the smarts and instincts of the thousands of experts on our team. While AI excels at
processing data, automating tasks, and providing insights for better decision-making.
And when they're used together,
They are far more powerful than either is alone. Whoa. I've never felt more alive.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make business easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.
So if we could just get on to Jack Bogle then, because Jack Bogle pioneered this kind of investing, and he's the founder of Vanguard Investments. You've met Jack Bogle on a number of occasions, haven't you?
I've had that privilege, yes. I actually met him when I was a journalist before I worked at Vanguard, actually, when on his trip to Australia, when they launched the Vanguard personal investor function. So I had a great opportunity to share a stage with him, travel with him to his sort of philosophy around markets. And, he was evangelical. I mean,
he was a very special kind of person, wasn't he? And because he was really on the investor's side, wasn't he?
Absolutely. I mean, he basically worked out that you had to try and give investors, as he used to say, a fair shake. And what he saw was an industry which at that time particularly was had a lot of upfront fees, upfront loads, as they're called in the US, a lot of commission structures, a lot of cost that the investors were paying away. And, he sort of had, I guess, this epiphany that, when you actually looked at the short-term trading mentality of a lot of the stock funds in the US, they didn't actually outperform the broad market. And academics like Burton Malkiel, who wrote A Random Walk Down Wall Street, was on a similar sort of academic study around, well, hang on, rather than trying to pick stock A over stock B, what happens if there was just buy the whole market and let it work for you? Because certainly, Malkiel's research showed that, the US stock market had been this great economic sort of way to create wealth over time. And, we're not all, in fact, very few people have, someone like Warren Buffett's ability to invest and create that sort of wealth. But here was a vehicle which really democratized investment. Bogle's genius was to recognize that if you could capture the total market's return, but to do it, because obviously there's costs in doing it, you had to keep costs, really low as possible. So
he called that the cost matters hypothesis, didn't he?
Exactly, yeah. And, in many things in life, the more you pay, the more you get, right? Whether we're talking about luxury cars or computers, whatever it might be. Jack Bogle's argument was in investing, the more you pay, the less you get, because, you effectively reduce your net return by the amount that you pay away in fees. And the other piece of it, none of us know what the performance of markets or stocks or property will be in the future. But we can understand exactly what our costs will be going forward, because that's a known factor. You know what the fee is on the fund. You know what the fee is on the ETF. So you know what you're going to pay away in cost. What you don't know is what the performance is going to be.
Just going back a little bit to the Jack Bogle story as well, is that he found himself at 44 with 6 children to feed and no job. And he was in this position when he actually started this idea of investing, which I believe at the time was criticised for guaranteeing mediocrity. So he really had a lot of belief in trying to do something.
Yeah, yes, he absolutely had the vision around it. And yes, he found himself looking for a new job in his mid-40s because he was on the wrong side of a sort of merger boardroom power struggle. And he decided it was time to put what had essentially been his university thesis into effect, and that was really that. And it was called Bogle's Folly for decades, and it was spectacularly unsuccessful when it launched. I think the capital raising they had for it was 12 or $14 million, something like that, was pretty modest compared to what they were aiming to do. And in fact, there was even posters put up inside some pretty large brokerage firms in the US describing index funds as un-American. The sort of image of
un-American investing. That's lovely, isn't it? It's great.
Because as you said, it was aiming for average, and of course, we all want to be above average. And Jack was sort of pilloried, and absolute testimony to the will and the drive of the man to keep going when I think a lot of others probably would have given up. And, he built the Vanguard business. I mean, the secret really to the Vanguard story or the Vanguard effect is that he established Vanguard as a true mutual. So that the people who invested in that initial US fund or US company were actually became the shareholders. So it was that old-fashioned mutual structure.
For the benefit of members.
Yeah, for the benefit of members. So basically, Vanguard, as it creates revenue, it's got 2 choices, really. You can actually invest in new services, new products, whatever it might be, technology, or it can give the revenue back to its investors by lowering fees. That's really the only mechanism we have. So if you look at Vanguard's history as it's raised assets, and it's now over around $6 trillion in assets sort of globally, as assets have gone up, fees have continued to come down.
Yeah, but I believe Jack Bogle could have been Warren Buffett-style rich, but preferred to look after investors.
Yeah. Bogle's lasting legacy is really that index investing has provided competition to active fund management, and it's lowered fees for investors around the world. And, I don't think it would be in any shape or form an exaggeration to say Jack Bogle saved investors globally billions of dollars in fees.
Yeah, it's amazing too that he's inspired people enough to, what do they call them, Bogle heads? The cult of the Bogle heads?
Yeah, yes, that's a worldwide phenomenon. I mean, but these are people who are passionate about the investment philosophy that Jack Bogle espoused so eloquently over so many years. And I think, when I joined Vanguard, I think the first year I joined it, I was looking at some of the speeches that Jack Bogle did, and I think he counted that he'd done 63 speeches in America that year.
Yeah, so people really seem to love him and get inspired by him. He's a great man, sadly missed.
Exactly.
We've been asking for listeners' questions, and I think we should just preface this by saying that we're not giving any individual advice and we don't know about any listener's situation. But I guess this is more in your role as from the Self-Managed Super Fund Association. The listener, Ophi Maskey, has asked that she's thinking about the best options for her super. Are there any advantages of starting a self-managed super fund over just staying in an industry fund?
Oh, I think that's a great question. Obviously, as you said, it depends very much on people's personal circumstances. Self-managed super funds are a very flexible, sort of powerful vehicle to be able to invest through, because particularly for people like small business people, that it gives them advantages that they can't access through the sort of industry retail super funds. That said, self-managed super funds are not for everybody. They come with accounting costs. They come with, you need to do an audit. You, as the trustee, are taking on personal responsibility for every decision that the self-managed super fund makes. So from the Self-Managed Super Fund Association point of view, I think if you go to the association's website, there's actually a bit of a tutorial and a bit of a quiz there for people to say, just understand what the trustee obligations are that you're taking on as a self-managed super fund. Age is important. Unfortunately, as we get older and you get into the realm of potentially with cognitive decline, you have to think about, who's going to look after the super fund. Typically, you see husband and wife, partners within a managed super fund. One of them potentially is passionate about the super fund, does a lot of the, the investing, does a lot of the admin. The other perhaps less engaged. If one partner,
passive, we call them passive investors.
Yeah, exactly. But if one partner, if there's a breakup in the partnership, or one partner sadly passes away, the other can find themselves with a fair bit of complexity about something they don't know too much about. So you just got to be eyes open as to what the responsibilities are on you as a trustee of a self-managed super fund. And certainly within industry, or, I think with superannuation funds generally, pay attention to the costs. The other debate around self-managed super funds at the moment is how much money do you need before one makes sense. I think it's not just about account balance, because if you're a younger person, starting out 30, 35 in your career and whatnot, then it can make absolute sense to set up a self-managed super fund if you want to put your entire life savings into it and you want to be able to manage it. Because if you leave it until you're, say, 50, when you've got a decent account balance, you'll incur a tax bill to move it, to sell out of one fund and move into the self-managed super fund. So a lot of it's to do with your financial planning. I think that I would not set up a self-managed super fund if I did not have a good advisor to work with, because there's a lot of complexity. It's not, in some ways I think the term self-managed super fund is a bit of a misnomer. I know very few people with a self-managed super fund who do not have a trusted advisor, specialist advisor, sitting alongside them in the background, helping guide their way through it. And certainly on the administration, etc., a very few people actually do the whole admin piece themselves.
So just getting back to Vanguard for a moment, there's an interesting story about where the name of Vanguard came from. Can you just share that with us, please?
Yeah, Jack Bogle was a student of British naval history.
As you do,
as you are. He was at so Vanguard was it was based on I think it's the Battle of the Nile. I can't remember the year off the top of my head, but basically Nelson's flagship in the sort of battle in one of the famous naval battles with the French at the time. So people can look that up. But I think one of the things that attracted Jack to it was I think the British were undermanned, and it was like it was apparently a pretty stunning victory for
the David and Goliath story, wasn't
it? Exactly. Yeah.
So one of the most interesting things I've noticed on the Vanguard website is the Vanguard Interactive Index chart, which we'll put a link to on the website. Can you give us a bit of an idea about how a newbie should approach this chart?
Well, really, that chart, what it does, it allows people to understand the power of markets. So you can look at that and you can actually track what the Australian market's done, what the US market's done, what international indexes. I mean, the beauty of indexing is you can see what an entire market, whether it's a listed property market, whether it's a fixed income market, and you can see how those things will work together. That interactive chart allows people to put in different parameters, time frames. They can see how things have gone over the last 5 years, 10 years, going back, I think it goes back 30 years from memory. So it's just a great way of understanding what markets can deliver over time. And again, it comes back to that Vanguard message around stay the course, as Jack Bogle famously used to say. And, really it's about the long term. And if you go back to that chart now and look at it and put in the years around the global financial crisis, the sort of '07 to 10 years, and just see how sort of dramatic, and then go and look at it within 20 years, and suddenly what was a very dramatic event for anyone that lived through it. It puts it into a much broader historical context and shows the impact of it. And frankly, now it looks like it was significant, but not nearly as dramatic as those of us that lived through it remember.
Yes, it was just a minor blip, wasn't it, really, when you look at it in those terms? And I think that's just something that younger people, for example, should be thinking about as well in terms of their investments.
Well, I mean, one of the things with younger Australian investors, we've been 27 years, I think, since we had a technical recession. So you can understand, there's a whole generation of investors that don't really understand that markets can go down and stay down for quite a long time. So people need to be very realistic about their expectations about what markets can deliver. But looking at it through a historical lens is a great way to start.
Okay, well, just wrapping up now, Robin. We're directing this podcast at people who are just starting to become interested in the share market and have got no idea what's going on. What are the top skills you think they should be trying to develop to help them gain knowledge of the market and at least not lose any money?
I guess everyone has the objective of not losing money, but
that's what we're really focusing on here in this podcast. First step, don't lose money.
But I think the first step of any investing, though, is that you have to accept that you are taking on some risk. You're taking on some level of market risk. So the chances of it going down, is real. So people need to understand, particularly time frame. Now, that's one of the things. Okay, you're investing for 1 year, 3 year, 5 year, or 30 years. That makes a huge amount of difference to the way you're doing it. In terms of what skills you need to develop, I mean, I think it depends on how involved and how sort of hands-on you want to be. Because for some people, frankly, they'd rather spend their time with other things in their life rather than worrying about investing and making decisions and whether markets are up, down, sideways, whatever. And so I think the first question is really around what sort of investor you want to be. I would encourage people to be informed and understand what it is they're investing in. What's your super fund investing in? What the investments are that you're actually making, understand them, because if you don't understand them, then you're particularly going to be surprised and not always in a good way. So I think understanding it there, but you can, whether it's through your super or working through an advisor or doing it yourself, particularly through index funds, you can set a broad asset allocation that will actually match your personal risk profile, because nobody really understands how you react to the stress of sort of market events like you do. So I think from a default point of view is buy the markets where you think you're confident, or you think there's some chance to sort of outperform and do something different, then by all means tilt the portfolio. But to me, the default start point is don't overcomplicate it. Keep it simple, as you're trying to do on this podcast. Instead of trying to work out which of the top 500 companies on the Australian stock market I should buy the whole market. And then, if you see something that takes your, perhaps you may work in the health industry, and you might have a particular focus on something that you think you want to put investment into, by all means, take that sort of position and understand it. But I think the default for me is just buy the whole market, buy the international shares as well as the Australian market, because if you buy the US market, you're buying into Apple, Microsoft, these large technology companies that frankly do not exist in the Australian market. Mm-hmm. The Australian market is relatively financial services, banks and mining companies. It's only 3% of the world's market cap, the global share market capitalisation. So I would also encourage people, buy the market, but then buy the whole market.
People who are interested in Vanguard ETFs and want to learn more, where should they go to get some more information?
Well, the Vanguard website's a great place to start, because there's a bunch of information. I mean, one of the other legacies of Jack Bogle, I think, is we try, and I emphasise try, to speak plainly about, it's a complex world investing, but we try and speak in plain language, explain the concepts to people and help them understand what it is they're buying. And you want people to understand the investment products they're about to put their hard-earned money into, because they need to understand the risks they're taking. You certainly need to understand what the costs are that you're paying. And we try and explain that simply. If they feel like they still don't quite get that, then I'd say, look around to try and get yourself a decent advisor there are increasingly, as you're doing, if you're with great podcasts, there's no shortage of information around investing. The trick is to hone it down to the stuff that actually relates to you, and you can actually get real benefit from listening to it.
And you can also invest directly via even your industry super fund. I mean, I was just looking at my super, and I just noticed the other night that there's a whole range of Vanguard ETFs available to invest in directly from...
Sure. I mean, a number of the major super funds now understand that they I think partly as a competitive response to self-managed super funds, actually give people the option to invest directly in certain types of things. I think, like the top 200 companies. But, I guess one of the things to understand there is, when you're taking on those sort of self-directed decisions, I'd say a good thing is to leave a good portion of your superannuation money in the hands of the professionals whose job is to manage the money day in, day out. That's their full-time job. And by all means, get involved. And I think when people do make direct decisions, you typically are more engaged in it and actually learn more about how the whole thing works. So I think that's a positive thing. Best money you can spend possibly is on educating yourself about investing.
Okay, Robin, thank you very much. It's been a pleasure talking to you.
No worries, Phil. Thanks for that.
Thank you. Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any shares based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. And I'd also like to say a big thank you to Christopher Soulos of Garlic Breath Studios for all the fantastic help with the music production.
With Staples Business Advantage, you get the benefit of thousands of experts.
Plus optimizations powered by the latest technological innovations.
1 + 1 =
2.
3.
Whatever. Sign up today and save 20%.
Staples Business Advantage.
Business is
human.